Hello and welcome. My name is Jeffrey Kennedy and welcome back to another episode of Elliott Wave Junctures. Today we're going to look at a bar pattern actually, and we're going to look at one of my favorite bar patterns. And what this is a double close key reversal outside bar combination. Okay, now what exactly is all that? Because it's kind of a mouthful to actually say. Well, bottom line, what it is, here's a key reversal bar right here. Essentially what happens is we make a new high above the prior bar, but the close is actually below the prior two closes. That's where the double close key reversal comes into play. Now the outside bar combination part comes with the reversal bar, this bar right here being an outside bar compared to the prior bar right here. Notice we have a new high as well as a new low. So this is a bearish double close key reversal outside bar combination. Now down here over to the right, we have a bullish double close key reversal. Again, we make a new low below the prior bar, yet the close of this bar is above the prior two closes, and also too that bar right here, the reversal bar, is actually an outside bar in comparison to the prior price bar. Now, the reason I like these bar patterns is because they occur infrequently, and whenever they do, they tend to, more often than not, identify significant changes in trend or reversal in trend. And a good example of that, here's a price chart of the E-mini S&P weekly. And here's a good example of a double close key reversal outside bar combination. Number one, we make a new low below the prior low here. Also, two, the close of this bar is above the prior close as well as the prior close. So that's we close above the prior two closes. And also, this is an outside bar in comparison to the prior price bar. And look what happened as a result. Basically, we rallied through January, February, March, and even into April here. So again, this identified a very significant move in price. Here with Priceline, again, pretty much the same thing. What we actually have on this price bar, we have a higher high above the prior price bar, so this is a key reversal bar, but the close of the bar is below the prior two closes, and it's also an outside bar. So again, look what's happened in subsequent trading days. We've seen a nice move to the downside. In fact, the other day, actually, when we made this high here in Priceline, we were trading about $775 a share. Now look at what we did actually yesterday. We closed around $700 a share. Quite a sizable move to the downside. Now let me just show you one more thing here, one more price chart. This is CMG, ticker symbol Chipotle Mexican Grill, and the bar I've identified right here, this is a double close key reversal outside bar combination. Specifically, it is a bearish double close key reversal outside bar combination. But look what happened in price. In fact, let me just go ahead and point out a few more. Here is another double close key reversal outside bar combination where we make a new price high and the close is below the prior two closes. And the same thing occurred here actually in early March. So actually in March, on the daily price chart, there were at least two additional double close key reversals which did not work. Okay, so what happened? If this is such a great signal, why did it fail? Well, it's important to understand that the signal, this double close key reversal pattern, is not necessarily a specific buy-sell type setup. What it is, it's, how do I put this? It's a warning light. It basically allows you to look at a specific market and be ready, either to the buy side or to the short side. For example, let's go back to, say, the Priceline price chart. And I'll show you exactly what I'm talking about. Whenever I see this bearish formation here, essentially in my mind, I treat this as the setup, not the trigger. What I want to see in subsequent trading days is either a break of the low, and if I get a break of the low, I'm short. And if I'm short, I use the high of the bar as my protective stop. Well, if the prices move up instead, then I'm actually long with a protective stop at the low of the bar. I treat this bar pattern as a trade setup, not a trigger. What I look for in the subsequent trading days is for the high or low of the bar to be penetrated, and then at that point, I usually use either the opposite extreme, either the high or low, as my initial protective stop. That's how I work with this pattern from a trading perspective as well as an analytical perspective. So if we go back and say, for example, take a look at this example here. Well, once the bar pattern formed, I basically draw a line against the high and a line against the low. And what I essentially do is I wait for one of the extremes to be broken. And if it is indeed broken, then I'll use the extreme in this instance here. Like for example, we took out the high of the bar, I'm long, here's my initial protective stop. That gave way to a nice trade. If we go back and say take a look example for the price line, here's a line in the sand here on the low of the bar, the key reversal day. There's my protective stop. So on a break of that level, I'm short the market with a stop, initial protective stop at the high of the bar. And if we go back and take a look at that weekly example of the S&P, well, I got two lines I'm essentially looking for. If I take it out, then this would be my initial protective stop. The double close key reversal outside bar combination pattern is a setup. Travel through either the high of the reversal bar or the low of the